In this video, we are going to discuss the third section in the cash flow statement. This section deals with the financing activities of the business, and on the screen you see the template, the format of the third subsection in the cash flow statement. The typical inflows, the inflows in this subsection are from issue of shares or issue of debentures. There can be any loans that are raised by the business, they also contribute to the inflows. So when we are adding, we are referring to inflows which result from any financing activities of the business. So, financing activities, as discussed earlier as well, refer to the sources of funds, long-term sources of funds, particularly for the business, and any expenses on servicing these liabilities are also considered under the financing activities head. So, interest that you pay on debentures or on the loans is also considered a financing activity. Dividends are paid to the equity shareholders. These can be either preference shareholders or the common equity shareholders. If you pay EMIs on the loan or the principal amount is being paid in any way, that is also shown in this subsection, and redemption of any debentures or preference shares as well. Preference shares have a timeline, have a deadline when they are redeemed, they are repaid. So redemption essentially refers to repayment. And then you figure out the sum of all these activities. There are inflows and outflows. So net, what is the outcome? Are you receiving cash from the financing activities, or are you using cash in the financing activities? So let's get started with the same income statement that we've been using. And we have some additional information here. So with respect to provision for dividend to equity, it says all the proposed dividend was paid to equity shareholders. So it's just helping us understand the actual amount which was paid, because we are dealing with cash flow statement. So provisions are essentially a non-cash item. So we don't want to be confused between those two. Therefore, a clarification has been provided. All the other account balances in this statement are pretty much the same. I also have the same balance sheet with me, which we have been using, and using the numbers from these two statements, we are going to fill in this template. We are going to figure out the cash flows resulting from financing activities of the business. So we are going to begin with the inflows. We have to look for any issue of shares or debentures first of all. And shares and debentures are shown in the balance sheet. So I'll go to balance sheet and look for issue of shares if there is new capital that has been raised. The important point to notice is the 2019 previous year numbers are here, and these are the current year numbers. So this is the direction in which we should determine the change. Share capital was 14,000 and now it is 20,000. It is going up. That means more shares have been issued. And against those shares which have been issued, the company must have received money, income, cash. So we are going to show 6,000 as the proceeds from issue of share capital. New share capital has been issued, 6,000. This is an inflow. Then you have preference capital. Preference capital was 2000 and now it is 2000 yet again. There is no change. New preference shares have not been issued. Old preference shares have not been paid back. Then you have general reserve and profit and loss account, but these are appropriation of profit. They do not come under the financing activities. These are non-cash accounts as well. So we are going to ignore these. So no need to worry about this. Then is bank loan. Bank loan is also going up by 2000. So this is a source of cash. Bank loan is 2000. This is a source of cash for the business. All right. Current liabilities go to operating activities. We will not look at the current liabilities here. So the first section is done. Now we have to look at the outflows from financing activities. Have we paid interest, have we paid dividends, any repayments of loans. Let's look through the balance sheet first. From the balance sheet, whatever was relevant, we have already used that information. So these two and bank loan. Other than this, there is no other information which deals with financing activities, because financing activities are they are related to the long-term sources, and long-term funding sources include either the equity capital, the preference capital, or you will have loans or debentures. And both these are going to be shown on the liability side and under equity head and non-current liabilities. So you don't need to worry about looking elsewhere, at least in the balance sheet. Okay, so now we are looking for outflows. In the balance sheet, there are no other hints on the outflows. Let's go to the income statement. In the income statement, in this profit and loss account, we have to look for dividends paid or interest paid. Now, non-cash expenses, provision, indirect expenses. So in the indirect expenses, here is a note. It includes operating and non-operating, and non-operating expenses are finance cost. Finance costs are the interest expenses that you pay on loans, on debentures. So the 60% 60% is operating and 40% is non-operating. So 40% of 10,000 is 4,000. 4,000 is the finance cost. So interest on debentures and loan, 4,000. This is finance cost. Done. Let's go back. Then we are looking for any dividends paid, and there is preference dividend of 200. So preference dividend is 200, and these are outflows. So I'm going to put these in parenthesis. Then you have provision for dividend on dividend to equity shares 400, and all the proposed dividend was paid to the equity shareholders. So 400 is the actual payment made as well. Another 400 paid. This is equity dividend. That's it. And then you have transfer to general reserve, which we are not considering as far as financing activities are concerned. And there is nothing else that should go to financing activities. Yeah, that's right. So all we have to do now is to sum these up and write the final number. So this comes out to be 8,000, and this is 8,000 minus 4,600. This is 5 and 34. All right. This is the net cash from financing activities, not used in, because there are more inflows and less outflows. So from the financing activities, the cash has come into the business during the year after considering all the financing activities. That's it. I'll see you in the next video.